Yeah, so we can go through the question. So I think I had already shared there on the group, and I think you should be having it. So it is saying Falcon Limited deals in Italian shoes. It has a head office in Westlands, Nairobi, and branches in several parts of the city. Accounts of all branches are maintained in the head office books. The following information relates to transactions carried out by Eastlands branch for the year ended 31st of December 2014. The amounts are stated at selling price. The amounts having to be stated at selling price. So in this case, you have actually been given the opening inventory, the goods received from head office, the goods received from Southland branch, another branch, goods sent to Northlands branch from Eastlands branch, goods returned to Eastlands branch by credit customers, goods returned to Northlands branch by an Eastlands branch customer, then goods returned to head office, goods returned to head office, then goods stolen from Eastlands branch, then cash sales, and of course, now in this case, what credit sales. Then additional information you're having to be given. Goods were marked at a normal markup of 3/5. To clear some old stocks, goods with a normal selling price of 3 million were marked down by 20%. 2/3 of these goods had been sold by the end of the year. Other than the goods stolen, there were no shortages or surpluses of goods in the year. So required Eastlands branch inventory account, Eastlands branch markup account, and Eastlands branch goods sent to Eastlands branch account, goods sent to Eastlands branch account. So you're having to be called upon in this case to prepare 3 accounts. You have actually been called upon in this case to prepare 3 accounts. So we have in this case the Eastlands branch inventory account. So Eastlands branch inventory account. Eastlands branch inventory account. Then another account you've been called upon to prepare is the Eastlands branch markup account. Eastlands branch markup account. Eastlands branch markup account. Then we have in this case goods sent to Eastlands branch, goods sent to Eastlands branch, goods sent to Eastlands branch account, goods sent to Eastlands branch account. So what you have to take note here, it is that this particular account is normally prepared at invoice price or at the selling price. This particular one here, we're having to recognize the profit. Then this one is actually prepared at cost. This one is prepared at cost. That one is actually prepared at cost. So this one is prepared at the selling price or the invoice price. Then the markup account recognizes the profit. Then this one minus this one, you get this one. So this one is actually prepared at cost. So the goods will likely be sent to the branch at cost, will likely be sent to the branch at cost. So you've actually been given in this case the markup. So the markup, you've actually been given the markup. So another thing that is actually very important, you've actually been given the markup. So the markup, markup is actually in this case 3/5 is actually 3/5. 3/5 is actually 3/5. The markup is actually 3/5. The markup is actually 3/5. So in this case, it simply means that since these goods are, these particular figures you've actually been given at the selling price, so you've actually been given at the selling price. And of course, in this particular account here, we'll actually be recognizing the profit. We'll actually be recognizing the profit. We'll be recognizing the profit. So of course, this one is actually profit over the cost of sales. Is actually profit over the cost of sales. So we'll actually end up having to convert this particular markup here to a margin. So that in this case, whenever you're having to get what is the profits on the selling price to recognize here, we can be able to do what? The computation. We can be able to do the computation. And the same case, in this case also, we can be able to know how much was actually what? The cost. How much was actually in this case the cost. So of course, in this case, for our accounts here, we're going to prepare them in thousands. In thousands of shillings. We're going to prepare them in thousands of shillings. in thousands of shillings. So in thousands of shillings. So remember, you've been told the figures you've actually been given there are at selling price. And of course, this one you've actually been given what? The markup. So this particular account here normally recognizes the profits on either goods sent to or maybe goods received from what? From the branch. So in this case, it means we'll actually convert this one to a margin. And of course, to get the margin here, the margin will likely be equal to 3 over 5 plus 3. So in this case, it means the margin is actually 3 out of 8. It is 3 out of 8. It's actually 3 out of 8. So of course, you've actually been given the first figure there. You are told the amounts are stated. So the following information relates to transactions carried out by Eastlands branch for the year ended 31st of December 2014. The amounts are stated at what? At selling price. So this account is maintained at invoice price or the selling price. So in this case, you have the opening inventory. So Eastlands branch inventory account. So you'll basically have in this case the balance brought down. So balance brought down. In this case, you are actually having to be told it is 31,680. 31,680. So this means in this case, we'll likely end up having to recognize how much is actually the profit on this one. Is actually the profit on this one. So we'll end up having to credit. We'll actually credit this particular account here with the opening balance. So the opening balance in this case, it will likely be, so balance brought down. But in this case, the profit will likely be 3 out of 8. So the margin. So what is the profit on this selling price here? It will likely be 3 over 8 times, in this case, 31,680. Then this one will likely end up having to recognize the cost there. We'll likely end up having to recognize the cost there. So in this case, if you do 3/8 of 31,680, so we'll recognize the profit on these goods that were basically the opening inventory. The opening profit on these goods that were actually what? The opening inventory. So it will likely be 3 out of 8 multiplied by 31,680. So you should actually be able to get 11,880. 11,880. 11,880. So by the time they're having to close the previous year, it means in this case, the profits that was actually recognized on the closing inventory of the previous year was actually in this case how much? 11,880. 11,880. So you'll take 3/8 of that one. Then we have goods received from head office. So these are ideally what the goods that are actually sent to the branch. Goods that are actually in this case sent to the branch. So goods from head office. Goods from head office. Goods from HQ. Goods from HQ. It was 368. 368. Then in this case, we'll debit this one. So the goods sent to the branch from the head office will end up having to debit the branch inventory. Then we credit these ones. So in this case, we'll be able to credit goods to branch. Goods to branch here. So here we'll take the profit element of this one. So it will likely be 3 out of 8. 3 out of 8 multiplied by 700. Multiplied by 700, 368. 700, 368. So you should be able to get an amount of 262,638. Then we'll credit here also. We'll likely credit here also. So it will likely be goods to branch. So goods to branch. Goods to branch. But now in this case, we'll take the cost. So the cost is actually 5 out of 8. So if the profit is actually 3 out of 8, the cost is 5 out of 8. Because in this case, ideally, profit is equals to, in this case, the selling price minus what? The cost of sales. So basically the sales minus the cost of sales. Minus the cost of sales. So for us, in this case, to be able to get the cost here, we'll basically, in this case, say cost of sales is equals to the sales minus what? The profit. So we can ideally, in this case, take this particular amount here we minus from this one. Or alternatively, we can take 5 out of 8, we multiply by this amount to get the goods were at what cost when they were having to be sent to the branch. So in this case, it will likely be 5 out of 8, 5 out of 8 multiplied by 700, 368. So you should be able to get an amount of 437. So 437, 730. So 437, 730. So whenever in this case the goods are sent to the branch, so you debit the branch inventory account, then you credit in this case what the branch markup, and of course the goods sent to the branch, So this account is maintained at selling price. This one you recognize the profit on those goods sent. This one you recognize the cost element. So ideally what is happening, you take this amount, you minus this one, you'll be able to get the figure, the cost. You'll get the cost. At what cost were these goods having to be sent to the branch? If we remove the profit element, which now in this case, we are recognizing in the markup account. The profit element of these goods, you are recognizing in the markup account, like that. So then in this case, the other item, you've actually been told there were some goods which are sent to Northlands branch from the Eastlands branch. So there were some goods which are actually released from this particular branch to Northlands branch. So they were ideally reducing the inventory of this branch. So goods sent to Northlands branch from this branch. So this inventory was reducing. So we likely end up having to credit here at what? At the invoice price. Remember, in this case, this account we're having to maintain at what? Invoice price or at the selling price. So we'll credit this amount of 3360. So the amount was of how much? 4320. Oh, sorry, before that, there was goods received from Southland branch. So goods from Southland branch. Goods from Southlands branch. Goods from Southlands branch, they were of an amount of 3360. Goods from Southlands branch they were of an amount of 3360. So then in this case, we'll recognize the profit element on these goods. Goods from Southland branch. Southland branch. Goods from Southland branch. So you'll take in this case 3 out of 8 of this. So 3 out of 8. So you'll take 3 out of 8. You multiply by, in this case, 3360. You should be able to place it here. So 3 out of 8 multiplied by 3360. So you'll be able to get an amount of 1260. So that is the working for here. So goods from Southland branch, the profit element on this one, which goes to the markup account, you credit here. So it's 3 out of 8 multiplied by 3360. So in this one, you will take the cost of these goods. So goods from Southland branch, goods from Southland branch, goods from Southland branch. You will end up having to take 5 out of 8. You multiply by 3360. So you should be able to get an amount of 1260. An amount of, not 1260, but 2100. But 2100. So 2100. It will be 2100. So 2100. So these goods were received from another branch, which we're having to call what? Southland. So it increased the inventory at this particular branch in Eastlands. Then we have to recognize the profit element in the branch markup account. Then, of course, these goods at cost, you get 5 out of it. You multiply by 3360. Then the next one now, in this case, the goods were having to be sent out. So goods sent to Northlands branch from Eastlands branch. So they were now removing this inventory from this branch. So it means in this case, it reduced the inventory. So goods sent to Northlands branch. So they were of an amount of 4320. They were of an amount of 4320. Then you debit here to recognize the profit element. So you debit here to recognize the profit element. So goods to Northlands. Goods to Northlands. In this case, you're having to take 3 out of 8, multiply by 4320. So you'll get an amount of 1620. 1620. Then we debit here in the goods sent to Eastlands branch. So goods to Northlands. So we'll debit here goods to Northlands. So you'll take 5 out of 8. 5 out of 8 multiply by, in this case, 4320. 5 out of 8 you multiply by 4320. So goods to Northland branch, goods to Northland, goods to Northland. So 5 out of 8 multiplied by this 4320. So you should be able to get an amount of 2700. So this one will be 2700 like that, 2700 like that, 2700 like that, 2700 like that. So you'll credit here goods sent to Northland because it was reducing the branch inventory. You remove that inventory from this branch. Then in this case, you recognize the profit element in the branch markup on these goods. Then the costs, at cost, you basically remove it from the goods sent to Eastlands branch, goods sent to Eastlands branch. Then goods sent to Northland, so goods returned to Eastlands branch by credit customers. So there are some goods which are actually returned to the branch by what? By credit customers. Goods returned to the branch by credit customers. Goods returned to the branch by credit customers. So they return the goods, and therefore in this case, they'll increase the inventory at that branch. So goods returned. When they return the goods, the inventory at the branch basically goes up. So it was of an amount of 5280, an amount of 5280. It was of an amount of 5280 over an amount of 5280, amount of 5280. So these goods were returned to the branch by the customers. So they were credit customers. So the goods returned to Eastlands branch by credit customers 5280. So what it means by this, for example, if they had actually ended up having to call upon us to prepare the debtors account, then we would have credited the debtors account, but that account is not part of what you are preparing here. So if there was a debtors account, remember these were customers you sold to on credit. So they were now debtors. But now when they returned, it means in this case, the amount you're having to claim from them was having to reduce. So in the case we had a debtors account here, we would have actually ended up having to credit with this amount. But now in this case, we'll just end up having to recognize this particular entry here only, because in this case, it won't actually end up having to affect what the branch markup, or in this case, what the goods sent to the branch. So we'll debit, in this case, this particular account here, then we'll be able to recognize the credit entry in those credit customers account. In the debtors account, we'll end up having to credit to reduce the debtors amount from the account. Then goods returned to Northlands branch by an Eastlands branch customer. So there was a customer for this particular branch here who ended up having to return goods. But ideally, in this case, he didn't return them at Eastlands branch. He returned them at another branch. He actually ended up having to return them at another branch. So we'll eliminate the profit element on these goods. So they were of an amount of 1932, an amount of 1932. So goods returned to Northlands branch. Goods returned to Northlands branch. Goods returned to Northlands branch. Goods returned to Northlands branch in this case. So the profit element is actually 3 out of 8. So you'll take 3 out of 8. You multiply by the amount was actually 1932. 1932, then it will give you an amount of 724.5. 724.5. 724.5. Then the cost of these goods. So the cost of these goods. So goods to Northland branch. Goods to Northland branch. So 5 out of 8 multiplied by 1932. 1932. So you'll get an amount of 12 or 7.5. So 12 or 7.5. 12 or 7.5. So we'll eliminate the profit element. We'll actually eliminate the profit element here by having to debit the branch markup of this particular Eastlands branch, and the goods sent to Eastlands branch will actually also in this case end up having to debit. We'll likely end up having to debit that account. Then we have in this case goods returned to head office. So there were some goods which were returned here at the head office. So goods to the head office. Goods returned to head office. Returns to head office. Returns to HQ. So the returns to HQ were actually of an amount of 8160. 8160. They were of an amount of 8160. Then, of course, now in this case, the profit element. So returns to HQ. Returns to HQ. So 3 out of 8 multiplied by this amount, 8160. 3 out of 8 multiplied by 8160. So you'll likely end up having to get an amount of 3060. 3060. Then the cost of these goods, so returns to HQ. Returns to HQ. The returns to HQ, you take 5 out of 8. 5 out of 8 multiplied by 8160. 8160. So you'll get an amount of 5100. You'll get an amount of 5100. 5100. Then so goods stolen from Eastlands branch. There were some goods which actually ended up having to be stolen from the Eastlands branch. So goods stolen, it reduced the inventory at this branch. Goods stolen. The goods stolen was of an amount of 5760. 5760 of an amount of 5760. 5760 of an amount of 5760. So in this case, we remove the profit element on these goods which are actually stolen. We remove the profit element on these goods which are actually stolen by ending up having to debit the branch markup. But now we won't credit the goods sent to the branch. We won't debit the goods sent to the branch. What we'll debit is the loss of the goods. So in any case, we had a profit and loss account. We would have recognized this loss because we got the goods at cost. When they steal them, we have actually incurred a loss. So what ends up having to happen, you'll end up having to debit the profit on these goods. You debit, in this case, what? The P&L account, like an expense. Then you credit, in this case, what? The inventory. So the inventory will end up having to reduce because these goods were stolen from this inventory. Then now in this case, there was the profit element on these goods that were actually having to be stolen from this branch. We'll remove it here. But now the cost, because we got the goods at cost, that is the loss we actually incurred. So this one will basically come as an expense in the profit and loss account. It'll come as an expense in the profit and loss account here. So the cost is the one that in this case we'll be able to recognize that in the profit and loss account and not in the goods sent to the branch. So we can be able to, in this case, recognize what was the profit on these goods that were actually stolen by having to debit what? The branch markup account. So we'll take in this case 3 out of 8, which is the profit element. We multiply by 5760. So 3 out of 8, we multiply by the profit element, which is actually in this case 5760, which is actually 5760. So we can end up having to adjust here a bit. We can adjust here a bit. So this is the goods sent to branch. So goods sent to branch account. So we have in this case goods stolen. So goods stolen, the goods stolen. What was the profit element on them? So 3 out of 8 multiplied by 5760. So you'll get an amount of 2160. You get 2160. You'll get 2160. So, but in this case, we've been able to say the other account that will be debited is the P&L because it was a loss. So when they steal from you, you incur loss. It will be like an expense. So you'll debit in the books of accounts to eliminate this expense of these goods that were actually stolen from the business, So that was an amount of 2160. Then there were some cash sales which were made of 316,800 and credit sales of 371,116. So whenever they make the sales, in this case, it ends up having to reduce what? The inventory. Whenever they make the sales, it ends up having to reduce the inventory. So you have in this case cash sales. Cash sales were of an amount of 316,800. And then of course you have credit sales. Credit sales also reduced what? The branch inventory there of an amount of 370. 116. So as the branch inventory was actually reducing, so for the cash sales, they were getting cash. So if there was a cash account, you would have been able to debit because this amount was received in cash. So they will end up having to get cash. So we would have debited cash. Then the credit sales, in this case, we would have debited what? Debtors account or trade receivables account because they were selling on what? On credit. But ideally, now the inventory at the branch was having to reduce because these goods were having to be released off on cash basis and of course on what? On credit basis. Then the next statement, so the goods were marked at a normal markup of 3 out of 5, which you've been able to use to calculate the margin to get 3 out of 8. So that in this case, you can recognize the profit element on the selling price of these items in what? In the branch inventory account. Then to clear some old stocks, goods with a normal selling price of 3 million were marked down by 20%. They were actually marked down by 20%. So it means in this case, what they had actually recognized as a profit, they ended up having to mark it down. So they marked these goods down. What they had actually in this case ended up having to maybe recognize as a profit on these, they ended up having to mark them down, So they were marked down by 20%. They were marked down by 20%. So to clear some old stocks, goods with a normal selling price of 3 million were marked down by 20%. 2,000 of these goods had been sold by the end of the year. So they actually marked them down. It's like in this case, what they could have been able to recognize as a profit on them, they ended up having to mark them down by 20%. So while they were having to mark them down, it means in this case, that was having to do what? Reduce their profits. And therefore, the branch markup account, which basically recognizes how much profits are we having to get on these goods having to be sent to the branch, will likely end up having to reduce what? The profits. So to reduce the profits here, we debit. To increase the profit here, we credit. But now the profits are reducing because they were marking down, we'll debit. So that in this case, we can reduce what had actually been recognized as a profit on these goods of worth 3 million. So we'll debit to eliminate that profit of 20% that would have been able to recognize on these what? On these goods. So there was a markdown in the selling price of 20%. So a markdown in the selling price of how much? 20% of 20%. So markdown in the selling price by 20%. So there's a markdown in the selling price by 20%. So you can write markdown. Markdown. So they were marked down by, in this case, by 20%. So markdown 20%, multiply in this case by 300. It is 300 what? 3 million. Exactly 3 million. Yes, 3 million. It is 3 million. So if you do that, you'll be able to get 600,000. Then in this case, we'll be able to debit credits. We'll actually credit this account here. So markdown in goods. So the markdown in goods was actually of 600. So they were marked down. So we'll credit in this case the branch inventory, which is maintained at the selling price. Then we debit now in this case what would have been recognized as a profit there to eliminate that profit on these what? On these goods. The profit on these goods, the profit on these goods. So therefore in this case we can actually be able to compute the closing balance of, in this case, what? The closing balance of the inventory, the closing balance of the inventory. So you can do the balance carried down. Balance carried down. So you can do the balance carried down. So if you do the computation, so you should be able to get the totals there. So the total, this side should be 740, 688. So 740, 688. Then when you do the difference, it should be able to give you 34, 932. 34,932. You should be able to get 34,932. Then on this 34,932, you should be able to recognize what is the profit that they didn't actually realize on this closing what? Inventory. Remember, this is the closing balance of what? Of the inventory. But there's now, in this case, when they close with an inventory, there's a profit which they haven't been able to realize on it. So you'll compute what was that profit that in this case they didn't actually realize on this what? Closing inventory. that they didn't actually realize on this closing inventory. And of course, you'll end up having to do what? Debit it here. Just like in this case, the same thing we ended up having to do. Remember, this was the opening stock here, 31,680. This was the closing inventory for the previous year. So if it means it was the closing inventory for the previous year, there was in this case a profit element they ended up having to carry forward on it, which we computed here. So the same case, this is the closing inventory here. So there's a profit element on these items at the end of the year. So we'll end up having to compute this profit element on the closing inventory in the inventory account. We'll debit it in what? In the branch markup account. So it will actually end up having to indicate there's actually an element of profit on this closing inventory that they didn't in this case realize by the end of the year. So you'll compute it, and of course you'll end up having to debit it here. And ideally, it will overall in this case reduce what you would have been able to realize as a profit by the end of the year. So assuming you had actually sold all of them, then you would have been able to realize this profit. But it means you haven't been able to sell all of them. There's a profit element you haven't realized on it. So you calculate, and of course you'll debit it here. You'll likely debit it here. So it will likely be the balance carried down in the branch markup account. It will be 3 out of 8 multiplied by this closing inventory here, on this closing inventory here, which will debit it here. So it means when you open the subsequent year, this will be our opening balance here. The same way here, it will be here. And the same case, what we would have been able to get as what? As the end of the year profit, which was never realized, will be the opening balance here. That is for the subsequent year, So you can actually end up having to get the balance carried down in the branch markup account, So you can do it somewhere. Let's do it somewhere here. So the balance carried down in the branch markup account. So you just continue here. So there's a figure here which you can be able to put here. So you have the balance carried down. So balance carried down. You take 3 out of 8 multiplied by this 34,932. 34,932. So you'll be able to get a figure of 13,099. I think 13,099.5. So 13,099.5. 13,099.5. Then you can be able to balance it off. So it means you get the totals. You add this and you add this. So this side will be more. This side will likely be more. It should be able to get a figure of 275,778. So 275,778. Then you can now get the balancing figure. The balancing figure now in this case is the gross profit. That's why you end up having to call it what? A markup account. It just basically recognizes the profit elements on this exchange of goods. So the profit element on this exchange of goods, it should actually be able to give you the gross profits, which in this case will be the balancing figure. It will be the balancing figure. You should be able to get an amount of 514. So 254,514. So that will be the gross profit. Will likely be the gross profit on the exchange of these goods from the head office to the branch, or maybe from another branch to this particular branch here in Eastlands. Maybe from Northland to Eastland, Southland to Eastland, or maybe from a head office to Eastland. So the profit element on this exchange of the goods, so will likely in this case be that particular figure there, the balancing figure there, which is 254,514. Then with the goods sent to the branch, you can also in this case end up having to balance it. And of course, in this case, the balancing figure will likely be the purchases that were made by this branch. Ideally from the head office. Purchases made by this particular branch here. So you will be able to get 438.22. 438.22.5. So the total should actually come to 439,830. 439,830. 439,830. 439,830. And of course, now in this case, that's how you can be able to prepare the branch inventory and the branch markup, and of course, the goods sent to the branch account. So Take note that this one is actually prepared at the selling price. This one is prepared at the profit. You need to know the profit element. Then this one is actually prepared at cost. Exactly prepared at costs. Exactly prepared at cost. This one is actually prepared at costs. So here we basically recognize the invoice price at which the goods are having to be sent to the branch. Then here we get the profit element on these goods that were sent to the branch. Then when they're having to be received at the branch, in this case, in the goods sent to the branch, we recognize the cost element of these goods. So we take 5 out of 8. Here we take 3 out of 8 in the branch markup account. The balancing figure in the branch markup account is the gross profit on the goods that were sent to the branch. Then in this case, the balancing figure here will be the purchases. Will likely be the purchases that the branch actually ended up having to make. The branch ended up having to make. Then purchases the branch ended up having to make, ideally from the head office, because now in this case, these were ideally goods that were removed from what? From the branch, going out. But now these are the ones that were actually received. Some of them from HQ, some of them from the other branches. So the difference here basically gives you the purchases figure. Is like in this case, they purchased from the head office. They purchased from the head office. That is what actually ended up having to happen. It's like they actually purchased from the head office. So when they were given goods, you get the difference. You'll be able to get the purchasing figure for that particular branch, the purchases figure for that particular branch. So we can look at that other question. So there's another question in this case I had actually shared. There's another question which I had actually shared. Just still on branch accounts, So you should be having it X limited. So confirm whether you have that question so that we finalize on that one. X limited. And I had already shared the answer. So we're just going to go through. So we're just going to go through very fast. So X limited. So X limited deals in electronics goods. The head office is in Nairobi and has a branch all over the country. So all purchases are made by the head office and the goods are charged to branches at cost plus, at a markup. So at a markup of 25%, So the following information relates to Nakuru branch for the year ended 31st of December 2017. So we have in this case the opening balance, which is actually at invoice price. We have the branch debtors, we have the branch inventory, transactions for the year, goods sent to the branch at the invoice price, goods returned by the branch to the head office at the invoice price. We have some cash sales, credit sales, returns from customers to branch. We have a discount allowed. We have bad debts written off, branch expenses, goods stolen at branch, cash sales stolen at branch, not included in other sales, then cash received from the branch debtors. So they want us to prepare, in this case, 5 accounts. So the branch inventory account, branch markup account, goods sent to the branch account, and the branch debtors account, the branch debtors account. So of course, now in this case, we're having to say that in this case, the branch inventory account is actually prepared at what? At invoice price or at the selling price. Then the branch markup account is actually prepared at the profit value. Then in this case, the goods sent to the branch is actually prepared at costs. So that is what you should actually always, in this case, be able to remember. So you have in this case, the branch inventory account. This is what I'm having to say. It is prepared at the selling price or at invoice price. It is prepared at the selling price or at the invoice price. So can have it there. We can have it there. Then you can have, in this case, the branch markup account, branch adjusted markup account. branch adjusted markup account. Then the other account they want us to prepare is the goods sent to the branch account. Goods sent to branch account. The goods sent to branch account. Then you have, in this case, the branch data. So we can finish this before we look at an income statement. Branch data's account. So the branch data's accounts. So you have the branch data's account. So our figures are, as per indicated. Our figures are as per indicated. Our figures are as per indicated there. Are as per indicated. There are as per indicated there. So you can now, in this case, now look at the transactions that actually occurred during that period. So of course, you've actually been given the markup. You've actually been given the markup. You've been given the markup. So the markup is actually, in this case, 25%. So it means in this case, our margin will be equal to, in this case, 25% over 100 plus 25%. It will actually be equal to 25% over 125% over 125. So it's just 25 over 125. Alternatively, you can be able to put it into fraction. So this 25%, ideally it means what? A quarter. It means a quarter. So to get this one, you can be able to say, 1 over 4 plus 1, which is equals to a fifth. This is the same as a fifth. This is the same as a quarter. So it's the same. You can do a fifth, or you can use just the percentages the way they are. Just one and the same thing. You'll be able to get the same answer. So to convert to margin, in this case, it means it will be 25%, because this one is 25 over 100. 25% simply means 25 over 100. So it means our margin in this case, we'll take the numerator, 100 plus 25. It will be 25 over 125. So alternatively, this one is a quarter. So the margin will be 1 over 4 plus 1. It will come to a fifth, which is same as this one. It is just the same. It's just the same. So we have, in this case, the opening balance of the inventory, which you've actually been given there. So the balance brought down, you've actually been given 300,000. 300,000. And of course, in this case, we've been able to say you recognize the profit element on this opening balance in the branch markup there. So in this case, we'll actually end up having to say a fifth. We'll take a fifth of these 300,000. So a fifth of this 300,000. So the balance brought down now in this case here will be a fifth multiplied by 300,000. So you'll get 60,000. 60,000. So this one is 300. So it's 300. So like that. Then we have the branch debtors. The branch debtors opening balance. It is here. So the balance brought down. The balance brought down is actually 450,000. 450,000. So like that. So those are the opening balances you've actually been given. Then the closing balances as of 31st of December 2017. So that is for the branch inventory. So the closing balance is 250,000. So 250. So you can have the balance carried down. So you can put it here, balance carried down. So 250,000. This one is at the end of the period. So the balance carried down. So at invoice price is actually 250,000, because you've been able to say these particular elements here, you bring it here. So you recognize the profit element on it, which in this case is actually the balance carried down now here. Balance carried down, the profit element on it. You will take a fifth multiplied by 250,000. So you'll get, in this case, 50,000. You'll get 50,000. So it's just the reverse transaction of this. You can see this one, it's there. Sorry, it is supposed to be in the branch adjusted. So branch adjusted. This one is not supposed to be in the branch This one is supposed to be here. It's supposed to be here in the branch markup. So we have in this case the balance brought down. Balance brought down. So a fifth multiplied by 300,000. So you'll be able to get in this case 60,000. So this one is here. Then this one you can see. So it means when you open now the subsequent year, this basically will be the opening balance here. Then of course this will be the opening balance here. So the cycle goes on like that. So we have to recognize the profit element, which was not realized on this closing inventory, where we end up having to adjust the profits for the year by having to debit what the branch markup, the branch adjusted what markup account. So like that. So then we have in this case, goods sent by the head office to the branch at invoice price. So there were some goods which were actually sent to the branch. So goods sent to the branch. So the inventory of the branch was increasing. Goods to branch. Goods to branch. They were of a value of 2.5 million. 2.5 million. They were of a value of 2.5 million. So 2.5 million. A value of 2.5 million. So the profit element on it. So goods sent to branch. So goods to branch. You credit goods to branch in the branch markup. So the profit element is a fifth. So it will be a fifth multiplied by, in this case, the 2.5 million. You will get in this case 500,000. 500,000. Then you credit the goods sent to the branch. You credit the goods sent to the branch. You credit the goods sent to branch. In this case, you have the branch inventory. Branch inventory. So this one simply means you take what? 4/5. So 4/5 of that. 4/5 multiplied by, in this case, 2.5 million. You'll be able to get, in this case, 2 million. Or ideally, what you do, you take this 500, you minus from the 2.5. So you should be able to get the goods sent to the branch. So remember this one, we're having to maintain what the profits on these goods that have actually been exchanged. This one, you're having to say, we maintain this account at cost of the goods, at the cost. So the cost of these goods that were sent to the branch is 2 million. The profit element is this. Then the selling price, will add the 2, we'll be able to get this one. So that's how you basically end up having to do that one. Then goods returned by the branch to the head office. So this basically simply means the inventory of the branch was having to, in this case, do what? Reduce. So there were some goods which are returned. Goods returned from the branch. So the branch inventory was reducing because they were relinquishing some of the goods to the head office. By how much? 200,000. They were relinquishing these goods of 200,000. 200,000. Then we debit here the branch adjusted markup account. So goods returned. So we take our fifth, because that is the profit element on these goods, or by 200,000. So we'll likely end up having to get 40,000. I think it is 40,000. 40,000. Then the goods sent to the branch also, we debit. We end up having to debit. So goods returned. So goods returned. So we take 4 out of 5. 4/5 times 200,000. So we'll get, in this case, 160,000. 160. So when you add this plus this, you should be able to get this. So those are the goods that were returned at cost. Then there were some cash sales. So the cash sales basically having to reduce the inventory here. So cash sales. So cash sales. There were some cash sales. There were some cash sales in this case of 800,000. So whenever we would have had a cash account, would have debited. Then we have, in this case, credit sales of 2.7 million. They were still reducing the branch inventory at the branch. So these basically were credit sales of 2.7 million. But remember, when you make a sell on credit basis, it means you increase your debtors. So it means the debtors account here will increase by this amount, 2.7 million. So we have, in this case, credit sales of 2.7 million. So when you sell on credits, your debtors increase. Your debtors increase, so like that. So that is what will likely end up having to happen with that. Then we have returns from customers to the branch. So some goods in this case ended up having to be returned by the customers. So it means in this case there were some returns by customers, returns by customers over, it was over 100,000 returns from customers to the branch. So the inventory at the branch was having to increase to 100,000. So returns by customers to from customers to the branch. So this will end up having to still reduce what the debtors will likely reduce the debtors. So returns by customers over 100,000. Then discount allowed. So discount allowed will also reduce the balance for the debtors. So discount allowed over 30,000, but now it will be recognized as what? As an expense. It will be recognized as an expense in the income statement. It will be recognized as an expense in the income statement. Then we have bad debts written off. So bad debts written off also reduces the debtors, but you recognize it as an expense in the income statement. So it means you debit in the income statement. So bad debts written off was of an amount of 20,000. Was of an amount of 20,000. Bad debts written off was of an amount of 20,000. Then branch expenses, that is an expense. Goods stolen at the branch. So there were some goods which actually ended up having to be stolen. And therefore, in this case, it means it reduced the inventory at the branch. So the goods stolen at the branch of an amount of, in this case, 30,000. 30,000, yes, 30,000. So we'll eliminate the profit element on it. So the profit element, we said we'll end up having to eliminate it by having to debit here. But now the costs element, will likely end up having to eliminate it in the income statement. We'll likely eliminate it in the income statement. So we have in this case the goods stolen. What was the profit on these goods that was what was the profit to be realized on these goods which were actually stolen? So it will be a fifth multiplied by, in this case, 30,000, which will come to 6,000. So it means the 24,000 in this case, we likely recognize it as an expense. So now when you are preparing the income statement, we'll debit the income statement. We'll debit the P&L account by 24,000. So the cost element, you end up having to eliminate it as an expense out of your pockets in the income statement. So you'll end up having to reduce the goods at the branch, 30,000. Then we recognize what was the profit on these goods that were stolen, because the cost element is what we incurred when we are buying them. That will be the only expense we'll end up having to incur in our profit and loss account, Then we have, in this case, cash sales stolen at the branch, not included in other sales. So there was some cash that in this case was actually stolen at the branch. So this basically simply means so they're having to say cash sales stolen at the branch, not included in other sales, So of course, in this case, these particular items that were actually stolen, this particular cash that was actually stolen, basically it means they had actually sold these items. They'd actually sold these particular items at the branch, but of course they won't end up having to realize this amount. It's just like in this case, the items is like they got lost. The items ended up having to get lost. These items that were supplied to the branch worth 15,000, they won't end up having to realize any money out of it, because it's like in this case, the amount was actually stolen. So it won't actually even be remitted to the HQ. So it's like in this case, the goods ended up having to get lost at what? At the branch. So we'll end up having to eliminate this value of these goods. This value of these goods. So because we've actually been told the cash sales stolen at the branch, these amounts had not been included in other sales. So they had not yet actually recognized them as a sale. It's like in this case, they were still like in this case, what? An inventory at the branch. So we'll have in this case the cash stolen of an amount of, in this case, 15,000 of an amount of, in this case, 15,000 of an amount of, in this case, 15,000. So this will also be part of the expenses we'll recognize because this amount actually got lost. So it's like we'll end up having to pay out of our pocket this particular amount. We'll end up having to pay out of the pocket this particular amount, and we won't recognize the profit element on it because you're having to say they are not actually yet recognize them as part of the sales. They are not actually recognize them as part of the sales, So I think those are the entries, or basically the transactions that in this case we'll likely end up having to have there in our accounts. We'll end up having to have there in our accounts. And of course, we can actually end up having to balance them. So there's one last item, cash received from branch debtors. So these debtors ended up having to pay. So cash received. So these debtors paid from the debtors. It reduces the debtors amount. It was of 2450. So when the debtors pay, it reduces their balance. You will credit, but now you debit your cash account. But of course, here we haven't been told to prepare the cash account. So we won't end up having to prepare it or basically indicate it as it is having to be debited because it's not part of what you're having to do the computations here. What you're having to do the computations here. What you're having to do as computations here. So we can now, in this case, end up having to balance our figures there. We can actually balance our figures there. We can actually balance our figures there. We can balance our figures there. We can actually balance our figures there. Balance our figures there. So we have in this case what? The balancing figure here. We can have the balance carried down. Balance that was in this case actually carried down. So we'll have an amount of 1095,000. So we'll get a total of, you should be able to get a total of 3,995,000. So 3,995. 3,995,000. 3,995,000. 3,995,000. 3,995,000. So we'll get 3,995,000. 3,995,000. Then so of course in our previous question we were able to see that we were told that in this case there were some items that in this case ended up having to be marked down. There were items that actually ended up having to be marked down. So whenever now in this case we have the debit balance here, whenever in this case you have a debit balance here, so it means there were some items that in this case they ended up having to mark up. So to get the difference here, they ended up having to mark up some of the items. They actually marked up some of the items. So in this case, because already you have the balance carried down of the inventory here. So, and of course, now in this case, we're having to say that the total after the balance carried down is 3,995,000. And of course, in this case, the total is actually here. So there's a balancing figure here. There is a balancing figure here of 10,995,000. So this particular balancing figure here, what it simply means in this case, there were some items of this inventory that were actually marked up, for us to end up having to have, in this case, what? A balance carried down of 250,000 by the end of the year. So this particular debit balance here will be an indication of what? Of a markup that was done on what? On part of the inventories at what? At the branch. Remember the previous question, in this case, we had what? A markdown, which was actually here. There was a markdown on the goods. And of course, at the end of it all, we were not actually in this case having what? A debit balance at all. So we had in this case what? We had in this case what? The balance carried down at the end of the year. But now in this case, there's a balancing figure. If you do the totals, you end up having to get a balancing figure here. So it means in this case, these inventories at the branch, they were marked up by this amount of 1095,000. So this was a markup. So it was actually, they were marked up. It's only that in this case, you haven't been told, but because now in this case, you have the debit balance here, is an indication of what? Some of the items of the inventory having been marked up by the balancing figure here. And of course, if you have the markup of these goods having to be here, then we'll also in this case increase our adjusted markup. So we'll end up having to increase our adjusted markup by having to in this case do what? Credit it here. So we'll likely credit it here. So it'll likely in this case branch stock markup. Branch stock markup. Branch stock markup of an amount of 1095. So 1095,000. 1095,000. 1095,000. And then in this case, we can actually get our totals. We'll likely get our totals. So this one should be 1655,000. 1655,000. So we'll have our balancing figure, which now in this case will be the gross profit. Gross profit. Gross profit. So in this case is the balancing figure. Gross profit recognized on these items will likely in this case be 1559,000. So 1559,000. Then we can balance the goods sent to the branch. So we'll have the purchases by this branch from the head office. It is 1840. So this is the balancing figure. So this is the balancing figure. So 1840,000. You should be able to get 2 million. So this one is 2 million. So that is 2 million. That is 2 million. Then we can also balance the branch debtors account. So with the branch debtors account, you'll have a balance carried down of 550,000. So there'll be a balance carried down of 550,000. And of course, you'll have a total of 3150. It'll be 3150,000. So 3150,000, 3150,000. It will be 3150,000, 3150,000, 3150,000. So we can look at now the very, very final part, which is now what? The income statement, which is the income statement. Which is the income statement, which is the income statement. So I can see someone is asking, which question are we handling? So it is on WhatsApp. It is on WhatsApp. So that this particular question is actually on WhatsApp. It is on. I had sent it yesterday. In fact, I had sent the answer. It's only that I'm just having to go through, brush through. I'm just having to brush through. I had already sent the answers for the questions we are handling today. So I'm just having to brush through so that in this case, if there was any query or doubt you had, then in this case, we can be able to move together. We can be able to move together. So once we finalize by having to look at the income statement, so hope you are through with that. So confirm whether you've actually been able to write everything before I end up having to rub, before I rub. So confirm whether you've been able to write everything before I end up having to rub. So we can look at now the income statement. We can look at the income statement. The very, very final part, the income statement. So X limited income statement. So X limited income statement. For year ended 31st of December 2017. 31st of December 2017. So of course, for the income statement, we'll automatically start with the sales. We'll start with the sales. So you've been told there were some cash sales. There were some cash sales of 800,000. But of course, there were some cash sales which were actually stolen, which haven't been included in sales. So we'll take 800 plus 15. So this one, the cash sales which were stolen, you are told they were not actually included as part of the sales. So we'll actually include them to know how much was the total sales. It will come to 815,000. Then you have the credit sales. We have the credit sales. So credit sales, in this case, we had 2,700,000. But of course, there's somewhere you've actually been told there were some sales which were returned. Returns from customers, I think, to branch. So there were sales which were actually returns over 100,000. So over 100,000. So that comes to 2,600,000. Then we can look at the cost of sales. Can look at the cost of sales. So the cost of sales in this case, we'll start with the opening inventory. So the opening stock. So this one, you end up having to recognize them at cost. So these ones will likely be at cost. They'll likely be at cost. They'll likely be at cost. Not at invoice price, but at cost. They'll likely be at cost because you purchased them at cost. So for this opening inventory, you've been given the invoice price is actually 300, but there was a profit element on it of 60. So there was a profit element of it of 60 in the branch markup account. So this one was, of course, in this case, 300 at the invoice price, but you're having to say recognize them at cost. So you minus 60. And of course, that will likely end up having to give you 240,000. So 240,000. So then you can end up having to add the purchases. You add, in this case, the purchases that were actually done. The purchases that in this case were actually done. So these ones you can actually end up having to get them from the goods sent to the branch. You see that balancing figure of the goods sent to the branch. So it is 1840. Those are the purchases of this branch. So you get it as the balancing figure there. So then there were some goods which are actually stolen. Less goods stolen. So still these ones you end up having to recognize them at cost. In total, the goods that were actually stolen was actually 30,000. But of course, there was a profit element on them of 6,000. Remember, this one you're having to maintain this particular cost of sales. We are getting them at cost. So what was the cost we incurred when we purchased these goods that were actually stolen? So of course, the value of the goods having to be stolen was 30,000. but we purchased them with 6,000 less. That is the profit element on these goods, 6,000 less. So the cost is actually 24,000. Exactly 24,000. Then we have now the closing stock. Closing inventory, still you recognize it at what? At cost. So of course the closing stock at the sales price value is an amount of 250,000. But of course there's a profit element on it which you have to eliminate of 50,000 because you are recognizing the cost of sales at cost price. What did we incur when we bought them? So 250,000, you less the profit element on them, which is actually 50,000. Which is 50,000, you end up having to get exactly 200,000. So you less 200,000. And of course, you can be able to get the cost of sales. So you'll get a figure of 1856,000. 1856,000. You'll get a figure of 1856,000. So the gross profit in this case would likely be 1559,000. Will be 1559,000. Then now in this case, you can less the expenses. You can now consider the expenses that were incurred. The expenses that were incurred. So the first expense, you've been told they were branch expenses. The expenses at the branch, they were 500,000. Branch expenses of 500,000. So these ones you just automatically less the way they are. There were some bad debts which were written off. So bad debts written off over 20,000. So bad debts written off of 20,000. Then we have discount allowed. So discount allowed of 30,000. So you less it. Then we have in this case cash sales which were stolen. There was some cash which got lost of 15,000. Then we have goods which were stolen at cost. The cost incurred to buy these goods was 24,000. So when you less, you should be able to get 970,000 as the net profit for this branch. So this is the net profit for this particular branch. So those are basically you can be able to get the profit for the branch, profit for the branch. Yeah, and of course that's how you come up with what with the income statement. That's how you come up with the income statement. So that's basically ideally how you could have been able to handle those particular two questions for what? For branch accounts, So take note that in this case, it is almost 100% guaranteed they won't test this topic. It is almost 100% guaranteed they won't test this topic, but of course it is part of the syllabus. That's why we've actually ended up having to do what? To go through it. But I can assure you the other lecturers, they won't teach it. They won't teach it. So they don't test it. They don't test it, but it is part of the syllabus. So branch accounts. So branch accounts. So I think we've actually been able to cover so most of the computational areas. We've actually been able to cover most of the computational areas. I think all of them, unless there is one that is actually having to miss out, maybe you can be able to go back. So what is going to happen? There's some two areas of theory that I actually covered in there was a lunch hour class yesterday. There was investment property, and then of course there was also another one, contingent asset and contingent liabilities. So there are some more which I haven't actually been able to cover. So, but I think we'll be able to cover in the subsequent lessons you are having. as we start looking at what the block revision, we start looking at the block revision. So I just try to balance the remaining theory parts and of course block revision for the computational parts, So that is what is exactly going to happen from next week. So I'll send a list of a number of questions that will likely be looking at them during the blocks. You can try to do them by yourself. Then when you come to class, you try to get a better understanding as we go through them. So the questions we'll end up having to handle, so they are the ones we haven't tackled during the normal classes. There'll be very, very new questions from the past papers. So what will happen? So you can go through them quite early in advance. Try to even practice by having to do them. You find difficulties. Then when now in this case we come to class, we are going through them now on the board. It will be far much very easy for you. So you'll basically now get a better understanding, correct yourself where you could have been able to make a mistake or maybe an error. And of course, that's basically how you'll be able to sharpen yourself. So with financial reporting is more of what you're calling having to practice more, and you practice more. So the more you come across difficult situations or maybe challenges in questions, the more you get to comprehend and actually in this case do what? Understand. The more you get to understand and of course in this case do what? Comprehend. So that's what in this case we'll likely end up having to do from next week. So I'll share a list of a number of questions. So I'll share them on the WhatsApp group. Then of course you can be going through them in advance. Then when you come to class during the revision, you can now get a better understanding as we go like that, So that is very important. So unless there's a question, so I would like to end there today's class. So prepare yourself for us to be able to start the block revision. From Tuesday. So unless there's any question, I can see Valerie here. Did we finish hire purchase? Yes, we completed the hire purchase, unless there's a video missing. Of hire purchase, but we completed the hire purchase. Unless there's a video missing of hire purchase, but we completed hire purchase. We did hire purchase unless there's a video missing on the LMS. What are the 3 topics that can never miss? So the most predominant topics that we obviously know they'll be in the exam, it is group. There are 2 that are constant: group accounts and published financial statements. So group accounts and published financial statements. So these ones, they'll be there. These are like standard. They're usually there. So the others, they'll end up having to vary. So it'll depend. So they can end up having to, if, for example, the previous sitting, there was no partnership, most likely they'll bring partnership this time round. So if there wasn't partnership, they're likely to bring partnership this time round. Then, of course, they'll be able to get questions from the other areas. And of course, when you talk about, in this case, group accounts, so for the group accounts here, they can bring, in this case, a question involving a holding company and, of course, a subsidiary plus an associate, or they can just bring the 2. Or they could go to the extent of having to bring a question regarding group cash flows. They can bring group cash flows. So here under published financial statements, they'll ask a statement of profit and loss. They can ask a statement of financial position, statement of changes in equity. Then sometimes, but very rarely, they can also ask about cash flows. There can be a computational question on cash flows, but they really like these 3. From published financial statements. And also in group accounts, they really like these ones. But you might end up having to find that they can bring group cash flow. They can bring a question on group cash flow. So just be able to prepare yourself. So on these particular areas, regarding what group accounts and of course what published financial statements. So for the other areas, let's see what happens in the next 1 month. Maybe we'll be able to know what is probably likely to come from the other topics. So let's just start preparing for the blocks. We'll see what will probably in this case will be the areas you're having to feel like high chances they might test from the other areas. But if partnership wasn't there, the previous sitting, it is likely to come. It's likely to come. So, but we'll see. By the time we're having to sit, before we sit for the exam, the very, very final week would have been able to know. But these ones is like, it is static. They'll be there. So these ones, in fact, you should just be able to start preparing for them without even having to ask whether it will be there or not. These ones, they'll be there. They'll be in the exam. So these two are usually there. These two are usually in the exam. So then, as I told you, don't ignore the theory areas. They are very important. They could be the savior. They could be the savior in this case. They could be the savior. So if you are just well prepared for them, then you can scoop some marks there. So averagely 25 to 30 marks will be from the theory areas. So you can imagine you having scored like almost 20% from those theory areas. Then you focus on these other areas like group accounts. If they bring, maybe you get 15, averagely 15. Published financial statements, averagely 15. Then the other areas they would have been able to test also, you end up having to score some marks from there. So you can easily end up having to pass this particular paper if you are well prepared. So the only thing that ends up having to put off students not to be able to pass with that mentality, it is difficult. That mentality is difficult. So if you basically approach the unit with the mentality is difficult and I'm not having to comprehend it, then that's where the challenge actually comes in. So you'll now in this case panic. You'll start panicking before the exam. So when the panic creeps in, then it'll now even be worse. It'll now even be worse. So you should have that confidence that in this case I can be able to pass this paper. It is advantageous because they actually pass. They end up having to mark what entries. In any question that we've been able to go through since we started the syllabus, there's no question I can score 0 because I'm guaranteed I can make some entries here and there. So what will bring for me a challenge is, for example, what may be workings. But with more practice, I can end up having to score some marks on the workings. So for example, in this case, if you look at published financial statements, there are certain figures that in this case, probably we don't end up having to make adjustments on them, especially in this case, maybe what in the statement of financial position. So you can't end up having to go into the exam with the mentality that I'll ignore a published financial statement question. So I should be able to get a mark. They're guaranteed. Even group, there are those ones we won't end up having to make any adjustments. It's a matter of just having to add holding company figure and subsidiary figure. Especially what I think current tax. There are some items there, current tax. If in this case it is trade receivables and trade payables, is for example, in this case, there were intercompany balances. I end up having to minus. The only thing that should be able to bring a challenge, if I don't interpret it so well, I won't end up having to compute the goodwill so well. I might miss out on that mark. But the other areas that in this case, you just add the figures, line by line actually, without any adjustments. So how can you go into the exam with the mentality that in this case, I'll score a 0 in what group account? It can't happen. Unless in this case, I don't know you are which kind of a student. It can't happen. It can't, because in this case, some of the items you add them line by line with 0 adjustment. 0 adjustment. And that is 2 marks actually. You'll score 2 marks because most of the questions in this case, they end up having to give what? 2 marks for each and every entry, especially under published. This one, they'll give 2 marks for each and every entry, correct entry you've been able to make in the final statements. And of course, it's also in this case, what sometimes in group accounts. So the entries, you won't make adjustment on them. So you should be able to try your level best. Try your level best that in this case, you don't actually end up having to leave what blanks, leave blanks in the exam, leave blanks in the exam. So I think I can end there for today. So let's meet on Tuesday, where we'll be able to start the block revision. So for the remaining part of the theory part, we'll just cover it. There are like 3 videos I've already been able to put on the LMS. You can go through those 3 videos. They are there. They are there on the LMS. You'll be able to see them. There's a separate folder for lunch hour revision classes. Can we repeat construction contracts and leases? So maybe we'll do a question on that. So let's see what happens. Among the questions I'll be able to pick out. The different ISS and IFRSs, kindly share the super highlighted notes on them. The different ISS and IFRSs. So of course that is when now we're having to say what the theory part. So the theory part. But for the theory part, if you just go through the videos, I've been able to explain them so well. You'll comprehend. Then when you go through the handout again, it will be good to go. It will be good to go with the ISS and of course what IFRSs. So because that from those particular theory, the theory part on the ISS where there are no computations is where they'll get the theory part from. They'll ask a question regarding maybe IS number 40. It is the IS, maybe IFRS number this. So, because that is part of what is basically under the theory part. So I think that is what will likely end up having to happen. That is what will end up having to happen. But I'll clear up going through what the theory part. I'll clear up going through the theory part. Any other concern that you might be having? Any other concern that you might be having? Any other concern that you might be having? So we'll select a question on leases and a question on construction contracts. So we'll go through it. We'll go through it, especially leases. That one is very crucial. Leases is very crucial. So if there's no any other concern, then I think let's end there. Then I think we meet on Tuesday. So I'll share the questions maybe by tomorrow. So could you please share a document with all the theory parts so we can print? So I think I'll reshare it again, but I think I had already shared it on the group, but I think I can be able to reshare it again. I will reshare it again. Any other concern? Any other concern? So I can see you are saying thank you and good night. So you can have a good night. So you can start enjoying the weekend.